Right now, global markets look green, with the VN index sitting comfortably at 1694. Buyers are holding the line, and the safety buffer looks solid. When the numbers glow green day after day, we get comfortable. We stop checking our downside and start assuming the current trend is a permanent reality. That comfort leads to a specific, expensive mistake. We either borrow money on margin to buy stocks we plan to hold for decades, or we refuse to cut losses on a quick trade that starts to drop. A quick momentum play hits a wall, we freeze, and suddenly that 3-day trade turns into a 3-year anchor, dragging down the entire account. If you mix your fast trading cash with your long-term investment capital, one bad market reversal will wipe out both. The recent strategy report from ArecaNG fixes this by demanding a hard, structural wall between two very different types of investing. This table shows two options. On the left, the active surfer uses margin for short-term gains. You log in daily with strict targets and no guessing. On the right, cash accumulation uses pure cash. You buy consistently and hold for 5 to 20 years. Before you hit the buy button on any stock, you must decide exactly which of these two rulebooks you are following for that specific dollar. Let's look at the active margin playbook. The entire strategy hinges on one condition: the VN index must stay above 1670. This chart maps the potential upside. While the index stays above that 1670 safety line, the market supports momentum trading. You can use leverage to capture rapid spikes in individual stock prices. The current report shows exactly what that looks like in practice, banking a 19% gain on Vinhomes or taking nearly 14% off the table with IDC. But the moment the VN index drops below 1670, the green light turns off. You must immediately cut your margin positions. No hesitating, no hoping it bounces back. Pulling this off requires serious work. You must open your account. Manually adjust your stop-loss prices on every trade, every day. You are trading your daily free time and your mental energy for the chance at outsized, leveraged returns. The active strategy also means managing a massive amount of data. The ArecaNG watchlist tracks over 50 different tickers simultaneously. You need the bandwidth to stock specific entry triggers, like waiting out Mobile World Group until it precisely crosses the 84,600 mark. You also have to know when to walk away flat. Sometimes that means taking a tiny fraction of a percent on PLX, or liquidating PVT at dead even, just to free up your capital for a better setup. Tracking 50 tickers and executing micro-adjustments takes intense focus. Surfing these waves is a job, not a casual hobby. If you can't commit to that daily grind, the report maps out an entirely different path, the ArecaNG magic rice pot method. This scatterplot maps out the risk and time commitment. The cash accumulation strategy zooms way out. It drastically lowers the required daily effort and immediate financial risk, but it demands absolute patience. You take a dedicated portion of your portfolio and buy shares with pure cash. Margin is completely banned here. You are buying these assets to let them compound over the next 5 to 20 years. The trade-off is psychological. Your money is locked up, and when the market dips, you must watch your portfolio turn red without panic selling. By sealing off this cash pool, you ensure your long-term wealth building survives the daily chaos of the trading floor. Deciding which path to take comes down to a brutally honest look at your own lifestyle. Can you check prices and adjust stop losses every single day? If no, you need to default entirely to the cash strategy. If yes, you need strict discipline to take a 4% BSR loss or secure a 15% TCH gain. Trying to run a highly leveraged, active strategy when you don't actually have the time to watch the market will drain your account. The entire ArecaNG framework operates on specific conditions. There is no buy and hold everything forever approach here. Margin is a tool, not an entitlement. If that 1670 index baseline breaks, you drop the leverage immediately. Your portfolio needs to be structured so that a sudden, violent drop in the market cannot force you to liquidate your 20-year legacy holdings. To get exact allocation percentages right, reach out to the ArecaNG advisory team to map out a plan based on your actual financial baseline. Building clear structural firewalls around your money will always yield a better return than trying to aggressively surf every wave the market throws at you.